So thank you very much, Luca. Thanks also for the opportunity to be part of this academy. Thanks very much. What I wanted to discuss today would be a bit on, the way the ECB as a monetary policy implementation institution has been working on adapting its own market operations to climate change challenges, and in particular, bring that in relation to covered bonds and covered bond markets. So my talk would be a little bit between that of Florian's and that of Professor Santamour's, would be elements of both. As I said, my role in the ECB is being part of the monetary policy implementation team. So as you know, the ECB has, let's say, these two legs, the monetary policy authority on one hand, and then the supervisory leg, the SSM, on the other hand. So I'm from the first side. Obviously, these are my personal views. Occasionally I will refer to more official views of the ECB, but other than that, these are really my personal views. And I wanted to say basically three things. I mean, this could be three different presentations actually, but I want to bring these three things together. One is talk a little bit in general about the importance of covered bonds in implementing monetary policy. And, some of you that are in the covered bond markets know all about that. The ECB has been active in different ways affecting the covered bond market, but some of the numbers, if you haven't seen them all together, they're quite a bit surprising, so I thought it would be interesting to start with that. The second is to give you an overview of what the ECB has been doing for its own market operations, in particular the ones that are related to monetary policy, to adapt these operations in the challenges of climate change. And the third is to talk a little bit, as Luca was saying, about the need for climate-related information, also for the particular case of cover pools. There's no need for me to say here, of course, why cover bonds are an important asset for the financial system in Europe, both from the point of view of the issuer as a financing tool and the point of view of the investor as a form of pretty safe investment because of the dual recourse and the high credit ratings. But perhaps what is less known is that it has been also a very, very important asset for implementation of monetary policy. So it might occur to you maybe as a strange thing that while the ECB traditionally and until 2009 has been implementing monetary policy only by providing liquidity to banks against collateral and not by buying assets outright, when it started buying assets outright, the first type of asset that it started buying was covered bonds. And since then, since 2009, there have been 3 programs of purchases of covered bonds. I mean, at the peak, somewhere in Q2 2022, the ECB had, the Eurosystem had on its balance sheet about 308 billion of covered bonds, and even today there is about 243 billion. So quite significant amounts that have been bought. So in terms of asset purchase, is one of the most important asset classes. In terms of accepting collateral when providing liquidity to banks, again, a very important asset class. When you see in the left, we publish every now and then this distribution of assets that have been actually mobilized by banks when tapping the central bank liquidity. And you see this purple part, which represents covered bonds. It's one of the major ones. In fact, today, covered bonds are the most used, the most mobilized type of asset among the marketable assets. So there is that's a purple part, and this it's red here, it's a little bit orange there. Part which seems to be even larger are credit claims, are bank loans that have been used as collateral, so they're not securities. So out of the securities that are used, cover bonds are the ones used the most. And if you add cover bonds and asset-backed securities together, you have almost 50% of the whole mobilized collateral today by banks whenever they require liquidity from the central bank. And of course, there has been a steady issuance trend for cover bonds. So the outstanding amounts that are eligible for operations have been increasing constantly, and you had issuance of cover bonds also during difficult times like the pandemic around 2020. So let me move just after that introduction, why this is an important asset class for us, on what we have done to adapt our operations to the climate change challenge. And a lot has been done in the context of our participation also in the NGFS, so the Network for Green the Financial System, where central banks and supervisors meet to discuss what is the role of central banks in this objective. Obviously, what we want to do is implement monetary policy, and we do that to ensure price stability. And there is an obvious impact of both transition and physical risks from the climate change to prices, which could be upward or downward, so that means it affects the volatility of inflation, so that immediately makes it relevant for monetary policy. So what we have done in terms of measures in our own operations could be divided in the two main types of operations that we do: buying assets and accepting assets as collateral. So maybe do that one by one. So perhaps what has been the most noticed part of that set of measures that we have implemented is the so-called tilting of corporate bonds portfolio, the CSPP, as we call it, portfolio, since 2022. So the idea there is to create a type of score of greenness, if you like, of corporate issuers, which is based on three dimensions. One is the level of disclosure of the issuer. The other one is backward-looking, looks at the emissions in the past, and the third one is forward-looking, looks in the future on decarbonization targets that this issuer has, and puts the three together in some number, which then, depending on how big or small the number is, we have been tilting our purchases of corporate bonds in the direction of those who have the best scores. So this has been going on since 2022. Of course, recently we have stopped refinancing the maturing corporate bonds. So, I mean, there's no active tilting anymore on that. Then going to collateral, which is the other type of operation, so accepting collateral when providing liquidity to banks. The first thing that we did already back in January was to accept an additional type of asset that was not normally eligible for our operations, which were sustainability-linked bonds. They were not eligible just because we typically accept only bonds that have very simple coupons, and this is a little bit more complicated, so there had to be an exception for this case. And that was already in January 2021. The second thing was that we announced that compliance with the CSRD would become an eligibility criterion for us. So those that are under the scope of CSRD and will have to actually comply with these requirements of disclosure to be eligible for our operations. Now, obviously, there's been a lot of going on around CSRD lately, so of course we have to also ourselves absorb the different developments there. So that's why this is still pending and it hasn't been implemented yet already, however, announced. And then, of course, when it comes to collateral, you have to do two things. You have to value collateral. Sometimes you have to value collateral theoretically, so through models, because there are not adequate prices. Some of the collateral that we accept is not very liquid. And you apply risk control measures, usually haircuts. So in doing that, we now systematically consider climate risks in determining both evaluation methodology and the haircut reviews. We haven't made any significant changes yet on either of the two, but more recently there was a decision by the Governing Council last July to look at also different ways, different approaches that one could apply to make a more systematic approach to how to incorporate aspects of climate change in the collateral value that we accept from, in particular, corporate bonds. And you might ask yourself, of course, why just corporate bonds? I mean, there are two challenges that you pretty much know. Whenever you try to incorporate climate change in the market, one has to do with the regulatory environment, which is in flux. You all know about the omnibus package, about reforming the CSRD. So things are changing, and then you have to adapt to these changes. And one point that we always try to make, is we don't consider ourselves as a monetary policy authority. We don't think we are the standard setters in this field. We want to support those that have the authority of setting standards, but we don't want to set the standards ourselves. So we need to follow them. And the second set of challenges has to do with data. You all know, if you are in the field, that data provided by different data sources are not always consistent. They don't tell you the same story. When it comes to physical risk, it becomes more difficult to get information. Physical risk, exposure to physical risk is in itself a bit complicated, because it's not only a function of where someone is incorporated, but where the activities of that entity are. There's a difference between information for large corporates and SMEs. Large corporates, usually the ones that issue bonds in the market, they tend to disclose more. There's more information at the entity level. When it comes to SMEs, there's less information, and sometimes you have to rely just on the information on the sector level. So, as I said, we don't think that the ECB is, it's not a question of thinking. We are not a regulatory authority, so we don't think we should be the one that sets standards. But I think what we could do, and we should try to do, and we are trying to do it, is that we can be the catalyst for the implementation of decisions from other competent institutions, such as the Commission, in the case of Europe, the EBA, and also our supervisory leg. And the other thing that we could do, and this is a forum to do it, which is to cooperate with you and to exchange views with market participants and build a pool of knowledge about how we can meet with these challenges together. So let me also go a little bit into the need for climate-related information. As I said, data is one of the major challenges that we have to deal with. I mean, when we talk in particular about cover pools, there has been in 2023, maybe you know about it, this joint statement of the supervisory authorities in Europe and the ECB. It was mostly focused on securitization, but there was also a part on covered pools of covered bonds, which was stating that it's a key priority to disclose climate-related information on underlying pools. And making reference to sustainability related to the disclosures for STS securitizations. I mean, the reasons why we would need more information are more or less obvious, but I just repeat them here. I mean, obviously, it's important for risk management and for investor protection, and then for us as monetary policy implementation authority, it's important when we buy these assets or when we accept them as collateral. I mean, it requires, I mean, it gives you more transparency. If you want to classify products and services as sustainable under the taxonomy regulation, for example, you need that information. I mean, of course, voluntary disclosures are good, but mandatory disclosures are better if you want to have a level playing field among issuers. And then going to the other leg of the ECB, the macroprudential monitoring. I just quote here a recent statement by Frank Elderson, who sits both on the board of the one part of the ECB, and he's the vice chair also of the supervisory board, where he said in a speech last month that as prudential supervisors, our true north is that no material risk remains unaddressed. And when we're talking about that, the financial risks stemming from the ongoing climate and natural crisis are no exception to that principle. So there are good reasons to have this additional information. Of course, you know there have been considerations about reporting requirements. You may have heard about the Corporate Sustainability Reporting Directive being postponed in its implementation and also changed in terms of the scope. I mean, we made a quick calculation because we were concerned about the implementation in the case of corporate bonds, and that from the corporate bond issuers that we are interested in, because they issue eligible corporate bonds, the reduction on the scope that is covered by the CSRD would be of the order of magnitude of 80%. So basically 80% less. Only 20% will remain under the scope. And of course, this leads to evoking the proportionality principle in general. So there are ripple effects from this omnibus package, and there's a general willingness to downscale the reporting burden. And I mentioned there some of the initiatives around that. But I mean, the general message that I would give here is that there is this perception, perhaps sometimes, that there is a trade-off, even a competition between two objectives: the objective of simplifying reporting requirements for competitiveness, and the objective of providing information related to climate. And I mean, the ECB has obviously supported competitiveness in the European economy and has welcomed the reports of Letta and Draghi and has said that many times. And clearly competitiveness is a worthy objective, but the idea is that enhancing competitiveness and supporting green transition are equally worthy objectives, and they are not really competing with each other. When it comes to simplification and on climate considerations, the two things are not really a dilemma. You either go left or you go right. And I think it's better to look at the simplification efforts and the efforts to transition to a greener economy as basically a package. It's a package which together would enhance competitiveness, rather than looking at it at one or the other as a trade-off. And I wanted also to say a few things about different channels that one could explore in Lucas' kind of idea to discuss different ideas that we can put, or different options that one could have. I mean, the EBA has been discussing, has Pillar 3 ITS template number 2, which includes at the bank book level information on climate change related variables. There's also the supervisory reporting templates, again from the EBA. Then you just mentioned the harmonized transparency template and harmonized disclosure templates that are related to labels. So that's also a welcome initiative. Of course, this is on a voluntary basis. And the other idea that one could float around, of course, why doesn't the ECB has its own templates? But there again, I would go back to my statement that I think we shouldn't be the ones that set the standards. It's much better, I think we are much better placed to support standards that are set by either by the market itself or by authorities. So I would like to finish here by repeating, the key message. I think the green transition for the ECB represents a strategic advantage for the EU. It is an objective to be pursued. And I think it is very possible to have a target simplification of reporting requirements, which is absolutely desirable, as long as this does not affect the framework to deliver on sustainability objectives. And I'll finish with that.